Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about home price forecast for 2025, especially the one by the Apollo Group that has home prices rising by 10.8%. First, as always, I want to thank our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast.
Wow, Sarah, someone actually went out there and said 11% national home price growth for 2025.
I know. So we have been publishing a lot of forecasts. We had the HousingWire forecast, right, that we published. We've been doing a whole lot of reporting on what everyone's saying. This was an outlier, right? So tell us, the Apollo Group, tell us what they forecast and why.
So Apollo has a series of updates year-round on pricing and the housing market. And if you actually look at some of their stuff, very similar to my talking points, but more about, why is it hard for home prices to crash? They always talk about, total inventory levels per person or per households are still very low. The nested equities are the highest levels ever recorded in history, home credit profiles. I mean, basically the standard stuff that any serious analyst would actually show. But this one caught everyone's attention to flat out say 10.8%. I think that was their forecast for 2025. And of course, everybody's like, what's going on here, but their economist has been right on the economy more than a lot of other people. So people are questioning it. So what I'm going to do today is I'm going to try to explain to you how I would model home prices if I needed something like that to work. And how do I model home prices actually falling? Because I don't think anyone has prices falling. Maybe Moody's, maybe 0.04%, something like that. But this way you can kind of understand that how somebody like Apollo could just come out there and say 11% home price growth for 2025.
So let's give it some context. What has been home price growth over the last couple of years? What's our home price growth forecast? Give it some context before you talk about that.
So here's the interesting aspect. Okay, so 2020, when 2020 came, before COVID hit us, again, people don't remember this, housing broke out and home prices were running at 8.5% before COVID hit us, because when home sales break out and inventory break to all-time lows, that's not a good thing. So while we were trying to grasp the COVID-19 recovery, a lot of people just forgot about that. So home prices were up 10% in 2020. Then hello, everyone, we need higher rates. Things are about to get crazy. Well, we were dealing with the forbearance crash bros who thought home prices would fall in 2021. It ended up being the third hottest home price growth year in over 80 years. 2021 had 19% home price growth. Then here gets to the interesting aspect of housing. 2022, my price forecast right on the knob, and for the right reason. Said rates would rise, home price growth would fall. I was completely 100% wrong, though. Even though the price forecast was correct, even though it was for the right reason, home prices were growing at 17 to 19% early in the year.
In
and if mortgage rates didn't get towards 7%, that forecast would not have worked. I would have been too low still. So that year, roughly 5 to 6% home price growth. And then in 2023, home price growth around 5 to 6%. I mean, you look at the history of home prices, naturally, 5% is the norm. In that context, inventory, new listings data started to fall. Inventory didn't really grow until the second half of the year. And because of that, even though demand was low, pricing still picked up. And this year, for 2024, my forecast for the year was about 2.33% nationally. And I said, I'm not a mortgage rate lockdown person, so inventory is going to grow. New listings data is going to grow. New listings data didn't grow as fast as I thought it would, but pricing really started to get firm around October in our weekly data. And because of that, I think we're going to end between like 3.1 to 5%, somewhere around there, which means I'm going to be wrong. My 2.33 forecast will be too low. Now Apollo went, there's a lot of people between 2 to 4%, but Apollo went flat out near 11% in 2025. So they are the outlier of everyone.
Okay, so tell us how they got there, and also tell us if you think that that's going to be more right than some of the other ones.
Okay, so I'm going to give you a model to how do you get 11% home price growth in 2025. Okay, this is not my take. You and I are going to do a 2025 forecast at the end of this month to go over it. And if you look back in the history of home prices from 1942 and on, 1943 to 1947 was the hottest home price growth period post-World War II. We're averaging like 20% even in some of those years. Inflation took off. The late 1970s, hotter home price growth in the late 1970s than 2020 to 2022. Inflation took off. The recent period of time where we had 10, 9, and 6% inflation took off. That was a more global pandemic, and then the disinflation happened. The housing bubble years, no, inflation did not take off. We didn't have CPI or PC. That was a major, major credit boom. Adjusting to inflation, credit was unbelievable. Credit boom, credit bust. So how Apollo is going to get maybe their 11% home price growth, because we're at such record low levels of sales. And total inventory, by the way, just always want everyone to remember, 2019 gets so much attention, but 2019 inventory levels were the 5-decade low in total active listings before COVID hit us. Okay, it's not this magical. I have a different view on 2019 inventory, but people think it's like, oh my God, it was the 5-decade low. We are nowhere close to the historical averages. If you want to look at the NAR data, they're between 2 to 2.5 million is normal going back to the early 1980s. Even the early 1980s, we had 3 million active listings kind of in the mid part of the decade. We are at 1.39 and the seasonal decline is going to happen. So we're not even going to get actually into the 2019 atmosphere in years 2020 to 2024. So, but I'm going to give you a time and period in 2013. 2013, inventory was much higher back then. Housing demand picked up a little bit, and from a very, very low base, and I think this is what Apollo is doing with their forecast. Because home sales were from a very low base in 2013, home prices ended the year at 10%. Since 1942, 18 years we've had where home prices are up double digits. So I'm assuming, this is just my hypothetical on Apollo, they believe because sales are so depressed, similar to what we had in 2013, that demand curve push with inventory lower than 2013 levels, that can give you near 11% home price growth in 2025. I'm trying to calculate how they look at it, how they look at things, but because there's so much equity and there's home sales are so depressed, that just that little demand curve higher, just like it did in 2013, home prices can grow 10%. Now, 2013 was interesting because in the second half, rates went up to 4.25, 4.5, and purchase application data started to fall, and then 2014, that data line actually regressed a little bit. So I'm assuming that they are just basically flatting out saying that because sales are so depressed and inventory is lower than 2013, that's how you get double-digit growth with demand picking up. Back then, mortgage rates were much lower, and Apollo isn't a rate-cutting, lower mortgage rate institution. So it is odd to me that they're looking at this as kind of just a natural inflation story, and wages are still very strong in their mind, and homeowners have so much equity that will release some of the demand and pricing will go up. And then you could say, well, in 2023, we had record low levels of sales. We had near 6% home price growth. So can the curve give you double digit growth with a little bit more demand? that it's a plausible theory. Definitely, you do have some history and models, so I think that's where they're coming from. Where a lot of people just, oh my God, that's crazy. Da, 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 da. So that's how I would say to forecast something like that. Still historical low inventory, still homeowners are doing very well. You get a little bit of push in demand. Inventory is not anywhere back to normal, and that will give you the price growth of 10%, which is the last thing I want to see. But I think that's how they get there.
Well, we're going to talk about a model that sees home prices going down, but it just real quick while we're talking about this potential, double digit growth, it really seems like it depends on demand. You are a demographic guy, right? Like a lot of your models are built on demographic. What do you see for demand that might justify that?
Well, it's interesting, Sarah. Today, this is Wednesday morning. Purchase application data was up again,
Yep.
and for the first time, I actually saw everyone on social media go, "What the hell's happening?" And what have we always said? I've witnessed this for 14 years. There is an inexperience in tracking purchase application data and forward-looking demand that is still relevant to me because I see it. But today there was almost a shock that even with elevated mortgage rates, we're seeing a positive growth demand curve toward the end of the year. Now, how I would explain it is that the last 2 years in November, December, we've had a push in demand. Now, it came with lower mortgage rates. Okay, so it kind of makes sense. We're very low levels. We're at historic low levels in purchase applications. So that makes sense. Here, that's not the case. We're still near 7, and you have a positive demand curve here. So how I try to explain this today in social media is that we're having to see seasonal increases starting in November and December, unlike the previous decade where that thing used to just start the second week of January. And because of that, the sheer size of 162 million people working, if you have any kind of seasonal push working from the lowest levels ever, you can nudge this data line higher. Just the raw number of people. And we saw that the last 2 years. We get 500,000 more home sales in 2023. It was 1 month. In 2024, this year, it was 2 months. And then rates run the show after that. So kind of look at it in that, because again, when you're working from the lowest levels of sales ever, you have 162 million people working, you have really good housing demographics, you have a lot of nested equity, no underwater mortgages, credit is flowing. It doesn't take much to move that needle. And if rates had fell towards 6% and stayed there, everyone's home sales forecast for 2025 will be wrong.
Yep.
It'll be too low. Everyone, NAR, us, everyone. We have seen the ability to grow sales throughout the year if you get mortgage rates down to 6%. But here it's just a seasonal push. But if you get that, that's something we have to think about next year. If mortgage rates go down, if it's sub 6%, we're growing sales like the new home sales sector has done since 2022. They're actually near, they're at 2019 levels. This would equate to 5 million existing home sales or above 5 million. So in this context, we have to just keep in mind is that we got the people there. This is an affordability issue, right? We needed to have price growth slow down, which was a positive, but it's not like the millennials are gone, Gen Z is gone, the baby boomers are dead, Logan's run, Gen X, we're still here. Everyone is there, but it's an affordability issue. So you get affordability a little bit better by lower rates. You can get sales that'll beat everyone's estimates in 2025. But it's the duration of mortgage rates. So the demographics are there. It's just an affordability issue. And obviously, hopefully by now, I've tried to explain to everybody the history of home prices going back to 1942. It is really rare for prices to fall. If you take 2007-11 out of the equation, it happened 1 year. More and more people are starting to go, whoa, I did not know that. 1% decline in 1990. A lot of that had to do with Southern California. So we got the goods. It's just an affordability issue. And because we're working from such low levels, it doesn't take much to move the needle.
Well, we're going to talk about mortgage rates in a minute, but okay, so we've talked about here's the model for seeing double digit growth. What's the model for seeing it fall more than anybody has that home prices would fall more than most people are forecasting?
Okay, so I have 17 different ways that home prices can fall in 2025. Okay, I always take what's the most likely scenario. I'm going to go back to the 2023 forecast. And back then I said, listen, if home sales keep on crashing, you can have price declines because the supply and demand equilibrium is still a declining marketplace. Now, the theory I had back then was that, okay, the next move is going to be lower mortgage rates if the forward-looking demand gets better and you miss it. That's going to be on you because we saw this in 2013, 14. We saw this in 2018, 19. We saw this in COVID. There's an inability to read housing data correctly. And by the time people wake up and realize, oh my God, what just happened? It's too late. So what happened is that forecast ran into November 9th, 2022. We stopped at 4 million. Everything is based off of that premise that we do not crash below 4 million home sales. However, what if mortgage rates go much higher than what people think? What if inventory starts to pick up faster? What if we see more distressed sellers in Florida? What if we see somewhat distressed sellers? I think it's different in Texas. The South kind of reminds me of Southern California in 1990, where you can have, assuming 1% to 3% home price growth nationally, everywhere else, but the South gets worse. And then the South nudges us on a decline. That reminds me of 1990, right? Where it was really Southern California's issue, and that brought home prices down 1%. That's a plausible. That's one of my 17, but that's one way you get prices declining out there. Hopefully now, Sarah, hopefully now everybody realizes the home price crash thing, the whole, all that stuff. When we see stress in our data lines, we will let everyone know. Trust me, none of you got the goods like we do, unless you're a paid client for Altos. Okay, we'll see it first. If we see, what mitigates to a home price crash, remember, 82 years of data on this, we'll let everyone know. But as of right now, that's just not the case. But that is one plausible theory on how you could have a decline in national home prices, because here it is. I mean, we're seeing, somebody told me, is like, there's no way home prices could rise in 2024 because of property taxes, insurance, and everything. I was like, dude, home prices are up this year. He's like, no, it isn't. Yes, it is. No, it isn't. I said, what are you saying? My own assumption. Okay, that's not how it works. All this data lines, everybody has home prices up. And but if you really want to have one variable or one model, that would be it, because we do see the South is different than the rest of the US. Now, again, rates, right? It really depends on where you're going to go with rates, because we are stuck here in this very, very low demand. But we can see what happened in June, right? Mortgage rates get down towards 6%, 18 positive week trends, and it's boosting up sales. Imagine if rates just get down to 6% and stay there. It's going to be very difficult to have kind of any meaningful decline in prices. But we keep an eye on everything for a reason. If something changes in the inventory data, we'll be the first to know. We want to be positive or negative. It doesn't matter. We need to see the data come out first. And that's one way that I could create a model for a price decline in 2025 to counter Apollo's 11% forecast.
Okay, if you're sitting out there listening and you're a loan officer, you're a real estate agent, you're somewhere in the housing ecosystem, you're like, okay, give me the over and under. What's more possible? What do you think is more probable to happen?
What is more possible, Sarah? What do you think?
No, I am not the economist. I need you to tell us.
You asked the question. What do you think?
Well, I think
you are my partner in crime. You know me better than anyone. So what do you think I will tell you?
I think you will tell me that you're going to come closer. Your forecast at the end of this year is going to be closer to the HousingWire forecast, because you were part of that forecasting team, even though it's not your personal one, than you will be to Apollo. I don't think that you will say that home prices will go down. I think that they will be they will be positive, but not in double digits. That's what I think.
You know what? When we did our HousingWire forecast, Mike Simonson and myself had a different view, right? So we kind of split it down the middle. at 3.5%. Now, my personal take is that inventory's up, affordability is bad. If we look at the history of home prices where we have an escalation period, whether it's the 40s, the 70s, or recently, you do have a kind of flat to negative trend in some of the years. So with that regard, my price forecast is going to be a little bit lower than Mike's because I still think we could have that supply and demand equilibrium, and we have the South. But on a national basis, we'll still be positive. But you have to remember that there are what we could possibly stress sellers in some parts of the U.S., but as a total whole, it still looks very firm, just for the same reasons Apollo showed. I don't think people still to this day understand how good homeowners are off. I mean, this has been something that for 10 years I've been talking about this, and I keep on hearing people, they are credit card debt. I was like, that's not these guys. Oh, credit card debt. It was like, that's again, not these guys. You're talking about single household renters in their 20s who are not homeowners. So how is that going to apply to this? And what's happened is everybody's been wrong about the economy. Economy's still expanding. You know, the consumption portion of GDP is still expanding. Black Friday, year-over-year sales, you know, especially on the internet, were good, right? So something is wrong with the view. I just think generally narrative people, certain people are not trained to talk about economics, especially credit data, and it's backfired on them, not just the last few years, but the last 14 years, right? We had the longest economic, people who remember me from the last decade, we had the longest economic and job expansion. You know how every single year I had to deal with the recession, people, you know? So, yeah, I'm still in the camp where affordability is still an issue, and the history has showed us that it's very hard to get kind of breakaway home price growth when you have this, unless mortgage rates go lower than my forecast. And I've always said 5.7. I cannot go below 5.75% on rates unless the spreads get better, labor market gets weaker. There's certain variables. If we break through that, my entire housing market thing changes. So we track stuff weekly. We hold everyone's hand. We are with you 24/7. This is why you follow HousingWire. We give you live daily models. We don't sit there and go, hello, we think mortgage rates will hit 6.5%. By the way, we'll see you in 3 months and we'll give you an update. No. Money never sleeps. I don't ever sleep. Economics never sleeps. We don't operate that way.
You
check
really
out the
don't
bond
ever
market
sleep.
24/7. That's why the Instagram family, we've got 500,000 people there for each month looking at 10-year yield charts. That's got to be really exciting, by the way. You know, so again, 5.75 ruins my forecast underneath there because I lose the lack of affordability. The supply and demand equilibrium changes with 6% rates. Below 5.75, different scenario.
Okay, let's talk about mortgage rates because this is Jobs Week. This is Jobs Friday. We have Fed presidents talking. Where are mortgage rates headed?
So let me take a look at I'm going to look at the 10-year yield. This is basically my life, is just looking at this app and where the 10-year yield is. It is very interesting.
We are recording this on Wednesday, so
we are recording this on Wednesday. So I am 419
for the 10-year yield.
We're below 420. Okay, so this week it's Jobs Week. Okay, so we had the job openings data. Okay, the headline beat. The internal still looks soft. And when I look at the job openings data, I see a lack of hiring and I see a lack of firing. Right. So job growth is finally, took a while, took the revisions, but we're finally at the levels that I've been saying we should be at for a long time. But we're not growing on, you know, kind of any strong level. We're not firing anybody in a very strong level. This is why we have positive reports still. So in that context, the labor market is softening, but not breaking. So the bond market didn't react too much. Now, this morning, the ADP number came in roughly in line in estimates. 10-year yield was at 4.28, but the ISM service sector, right, we're a service economy, that thing missed estimates by a lot. 10-year yield, waterfall dive. So we're just hovering right here. We're going to have Jobs Friday. Now, remember, okay, we have the hurricanes out of the data. We could be hiring construction workers for the hurricane areas now. Travel data has looked good. And retail sales and consumption has held up. So there's a possibility of a decent bounce from the last number that was like 12,000. We're going to see some revisions to that number too. and then we take it from there. But I'm kind of more focusing on the wage growth data, right? The Fed, Waller came out and talked about where we'll cut rates in December, but the wage growth data I still think is a problem for the Fed, because you people making more money. How are we supposed to get inflation check if you people make more money and you spend? Shame on you people. So I'm looking forward to see the wage growth data actually tick down. I think the last month's data inflated that number a little bit too much. And then we'll see how the bond market reacts from there. And right now, all that talk about 5% 10-year, 8% mortgage rates, the tariffs, inflation's taking off, everything. What happened? We hit that key level, we held that level, and we went lower. So again, wait till if the economic data starts beating estimates, we could talk about that. But let's keep the political, ideological stuff in the back burner and follow the data, because the economic city surprise index looked like it's peaked. It's falling down a little bit. 10-year yield falling down. It all kind of moves in this beautiful, lovely slow dance, out there. And the 10-year yield chart and the 30-year mortgage rate, mistletoe, hello, since 1971, a lovely couple. God bless them. They move it together. Sometimes they're close, sometimes they're far apart, but it moves in line for a reason.
I feel like the number of times that I've heard you say the labor market is softening but not breaking is just so many times. I feel like it's because, and I mean, that's good. Like, it's not like, oh, well, anybody's rooting for people to lose their jobs or a big recession. But when it comes to mortgage rates, we're not going to get the rates that will really stimulate the housing market unless we see some job loss.
So for 2 years, a lot of people, and I understand the frustration on this. Consumers were told that if the growth rate of inflation falls, mortgage rates are sub 6%. Not my take. You remember that conference we did 2 years ago? The Gandalf line. It's like, oh, everybody's telling me that. I said, nope, we're holding the line right here. Last year, labor market's getting softer. Okay, all right, that makes sense. But the hoarder line is still there, right? We didn't break through that. Softening and breaking are two different things. And what is the two data lines that we always focus on, Sarah Wheeler? I'll see if you remember this. What are the two labor data that are key to my economic cycle work?
Wages, right?
Wage growth is key for the Fed. But when we think about economics data's breaking, since the Peloponnesian War, it's jobless claims.
Right.
And what's happened is jobless claims data has gotten better after the hurricanes, and the Fed is like, okay, we're gonna get to neutral in a very slow way. If jobless claims were back in 2022, we say do not go into the recession talk until claims head to 323,000 4-week moving average and break off. I know a lot of you ask me about the continuing claims data. We have models tied to the civilian force of continuing claims, and it's still looking fine. Breaking is that data line goes out. And then what historically happens is residential construction workers start losing their jobs. Then manufacturing workers start losing their jobs. There is your 1960s, 70s, 80s, 90s, the last 6 decades. That's how every recession looks like. We're not there yet. And that's why I think that, if you look at how mortgage rates were before, pre financial crisis, 6 to 8% where the Fed funds, that's normal in that regards. I think the last decade we had zero interest rate policy and we had negative yields around the world. We had trillions of dollars of negative. We don't have that environment here. So I think you have to wait till the labor data gets weaker and breaking, and then you could have rates or the spreads get better. I mean, if the spreads were just back to work 6% more, you realize that we can grow sales and we could build more homes if the spreads are just normal.
Okay,
I mean,
finish that thought, because you trailed off. If spreads were normal, we would be where on mortgage rates?
We would be in the low 6s, right? Oh. In some cases, high 5s, just normal spreads. People would be buying more homes. The builders would feel better. Imagine that a country buying homes, having sex, having kids, building. That's how a powerful country works, right? Not that, oh my God, if mortgage rates get down to 6%, home prices will go, oh Lord, what soft little baby is that? Neil Kashkari. Oh, by the way, no, Neil Kashkari says housing demand is so high that the clearance rate is up. A lot of people finally figured out what I'm doing with him, right? Because that's not how it works. So I'm telling you, you have to be careful with some of the Fed's president statements, right? It doesn't work with current data. So spreads get normal. We're there. Spreads get normal with a 10-year yield just getting down to 380. That corridor line holds. You got in the fives. Everyone's we're building homes, we're buying homes. Oh my God, America. That's the one sector of the economy that's still at low levels. And we have so many people, 162 million people working. We have Gen Z, millennials, Gen X, nobody cares about us, baby boomers, silent generations. We have so many people ready to go. It's just rates, right? And of course, a lot of this has home prices escalated out of control. But I encourage everybody, this is not abnormal. We saw this in the 40s. We saw this in the 70s. It's the housing bubble, I would say, is the anomaly. We didn't have inflation there. That was a credit boom. And we had it here, global pandemic. So we'll take it one day, 1 week at a time. But man, if we just had normal spreads, so much would be different right now. Because if we have low sixes with duration, I know a lot of people thought you need fives or fours to grow. You don't. We've seen it in the data. You can grow sales.
We will be looking for that. We are out of time. Logan, thank you so much for being on. I encourage everyone, when the tracker comes out on Saturday, look for it. Logan tracks all of these things in great detail, has charts, and it sets you up perfectly for the week. But thanks, Logan, for being on.
Pleasure to be here, Sarah.